Bitcoin has been moving sideways for the last couple of months, but is it finally ready to break out? Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's global macro update, I will go through a huge chart pack that I've put together. We'll go through Bitcoin, rates, the economy, gold, foreign exchange, and much more. We will also break down our proprietary metric, TBL liquidity, and show you why the conditions are setting up very nicely for Bitcoin. To access this complete chart pack, go to thebitcoinlayer.com/subscribe and become a TBL Pro today. TBL Pros get all of our proprietary research, and we have a brand new product for TBL Pros, this beautiful 60+ page chart pack. In this first chart, I want to show you the Bitcoin price relative to its 200-day moving average and something that we call the short-term holder realized price. Now, Bitcoin's 200-day moving average and its short-term holder realized price, these are two metrics that we use as a valuation reference for Bitcoin. So we want to see where the price has been on average over the last year or so, as well as measure where investors, buyers and sellers of Bitcoin, are moving coins on and off exchanges. What is the price of Bitcoin when those coins are moving? So in red, our 200-day moving average is now above $80,000. This is, of course, an all-time high for Bitcoin's 200-day moving average. But really, it's fascinating to me that an $80,000 200-day moving average is the reality for Bitcoin. That tells me that the base of Bitcoin, where the price could go in a bear move, it's not drastically lower. When we think about Bitcoin's 200-day moving average around $35,000 when Bitcoin was at $70,000 just a few months ago in mid-2024, that was a valuation that had overextended itself. And what do you see subsequently what happened? Bitcoin consolidated for several months. So Bitcoin right now at 95 with its 200-day moving average at 80, it's not very overstretched. And that's the main signal that I want to take away here. On the short-term holder realized price, this number being at around 92,000 tells me that a lot of the price movement in Bitcoin is driven by actual on-chain movement. So let's give you two scenarios in terms of how the Bitcoin price can move. Number one, we have speculators on an exchange bid up the price. So they're bidding up the price to acquire those coins from somebody else, but keep them on their exchange. Number two, we have the buyer that buys those coins on the exchange and then sends those coins to his or her own hardware wallet or custodial situation. Now, when the investor moves the coins, that movement will hit our realized price metric. But when the coins are not moved and kept on the exchange, it will not affect our realized price metric. What that means is that an increasing realized price means that money is actually moving on chain. Bitcoin is moving on the blockchain from one custody situation to the next. And that is a bullish sign that investors are gearing up for long-term holding behavior. So it's a bullish underpinning to the market. The rules of the game have changed. The first 30 days of the Trump administration have ushered in a massive shift in Bitcoin policy. Regulatory clarity is emerging, institutions are stepping in, and America is potentially on the cusp of a national strategic reserve. Join Unchained for an exclusive online event with Connor Brown, counsel to U.S. Senator Cynthia Lummis, Preston Pish, and Matt Pines from the Bitcoin Policy Institute on February 27th at noon Eastern Time. The event will cover what's changed, what might be next, and how to protect your generational wealth. Don't get left behind. Secure your spot now. Make sure you go to unchained.com/TBL for all the information. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever, And the main culprit, the main reason is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush proof, and time proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. For more on realized price, TBL pros can go check out that chart pack and look at the MVRV Z-score. This is the relative valuation for Bitcoin throughout its history versus this on-chain movement. And right now we see Bitcoin at a very decent and fair valuation relative to its realized price. The next chart I want to show you here are the ETF flows. So we're talking about realized price moving. Well, what drives that on-chain movement? Right now, a lot of that movement is driven by ETF managers. So when Abu Dhabi's sovereign wealth fund buys shares in IBIT, Barclays takes that capital and through the financial system will eventually use that cash, buy Bitcoin through its authorized participants, and that Bitcoin will be sent to the custodial manager. Right now it's Coinbase acting on behalf of BlackRock. JP Morgan is the authorized participant. So Abu Dhabi buys the share. JP Morgan goes out and buys the Bitcoin, sends it to Coinbase, and BlackRock's AUM has grown. Bitcoin has gone into Coinbase's custody on behalf of BlackRock, sent to the wallet by the authorized participant, and that money has moved on chain. That Bitcoin has hit the blockchain. So even though we think about the Abu Dhabi investment company, the sovereign wealth fund, as not buying Bitcoin because they're buying shares in IBIT, the Bitcoin, not only is it purchased, but it is also moved on chain. So when we look at realized price, we're actually looking at ETF manager activity in part. So these ETF flows, what does it show us right now? It shows us that we had a huge inflow in January and in the beginning of February, but that those inflows have tapered off somewhat. So a neutral ETF flow in the current state of the market, and that's being reflected in the price. Basically one big chop here over the last couple months. Okay, this is a good one. This is the Bitcoin and S&P 500 rolling correlation. So on the top pane, what you have is stocks. In green, the S&P hit another all-time high. RIP to all the bears out there. And Bitcoin in orange is at 95,000. So you can see that these two assets have tracked somewhat closely over the last couple years. But in the middle pane and the bottom pane, what we have are 40 and 100-day rolling correlations. So what we do is we take the daily returns of Bitcoin, the daily returns of the stock market, and we compare those daily returns. And what you see here is that on a shorter term basis and even a longer term basis, correlations have fallen of late. That's as Bitcoin has chopped sideways and the stock market has grinded to yet another all-time high. So what does this mean for Bitcoin and what's the big takeaway? Well, if correlations are high and stocks are doing great, that's good for Bitcoin. But if correlations are low and stocks are doing great, that doesn't mean Bitcoin is going to share in the same benefit that the stock market is benefiting from. And right now, it looks to be like that's a little bit of the situation. We'll get to TBL liquidity soon. Liquidity seems to be supportive. Stocks are doing well, but Bitcoin is not trending alongside stocks. It's trending sideways, and that is causing correlations to fall. So why exactly are they falling? And does that set up a bullish or a bearish move for Bitcoin? That's something that needs a little bit more analysis. My takeaway right now is that the falling correlations in Bitcoin do set up for larger moves. And so we'll have to see if that move is up or down. We think that the move will be up because TBL liquidity, general liquidity conditions are supportive, but we will have to wait and see. This is a fun chart here, the Bitcoin to gold ratio. Right now, 1 Bitcoin is worth about 32 ounces of gold. Now, if you look at the chart, this is obviously a logarithmic scale here. We see Bitcoin reach 1 ounce of gold toward the end of 2013 and then finally skyrocket past 1 ounce of gold to 10 ounces of gold in the 2017 bull market. Right now, we are in the middle of the 10 to 100 ounces of gold section of this logarithmic chart. But when we think about Bitcoin, we do see that it will reach 100 ounces of gold at some point during the next few years. That would put Bitcoin at somewhere between $200,000 and $300,000. That is the path that Bitcoin is taking. Obviously, bulls will have to be patient here. And one of our main takeaways that we understand from using historical return analysis is that if you hold Bitcoin for 3.5 years, you probably won't lose any money. And if you can hold it for 8 years, you have the potential to not double or even 10x, but 100x your return using historical numbers. So thinking about Bitcoin hitting 100 ounces of gold obviously just about hitting 3,000 per ounce would put Bitcoin at around $300,000 per coin. That is something that we must keep in context. We're not here at TBL to be some out of control price predictor sending Bitcoin to $1 million next year. However, keeping Bitcoin in context of getting to 10 trillion or 20 trillion in market cap, which is $1 million per Bitcoin, is something that we always try to do. So even if it takes time, we explain to you the context for how Bitcoin can reach 100 ounces of gold, which would be $300,000, or how Bitcoin could reach a $20 trillion market cap, which would be $1 million per Bitcoin. So I go through the concepts around Bitcoin's cheap valuation at 2 trillion and why it can easily get to 20 trillion and one day $100 trillion in my book, Bitcoin Age, which is in its final stages of editing. And I hope you guys will go check out Bitcoin Age, to be released March 11th, 2025. People can go pre-order the Kindle version right now, but the hardcover is not available for pre-order yet, as I am still finishing the production on the book. This chart, TBL Liquidity, shows our proprietary metric here over the last 20 or so years. Now, what you see is this purple line chopping around the level of 50. So what we've done with our metric is we've taken it, put it on a scale from 0 to 100. Readings above 50 give us a positive environment for risk taking and credit creation. That's the key here. That risk taking stems from credit creation, and credit creation stems from the banking system and their abilities to create credit. So what is in this metrics? Number one, the size of the banking system, so their asset base. Number two, rates on treasuries. When treasury rates go down, the banking system is richer for that move, and therefore they can create even more money because of fractional reserve banking. Number three is bond volatility. Low bond volatility is conducive to better market making, which is conducive to better credit creation. And lastly, the dollar. A weak dollar is an easy financial condition for the rest of the world to borrow. And a strong dollar is a tight financial condition. So a weak dollar supports TBL liquidity, lower rates supports our metric, and lower bond volatility, of course, supports our metric, and a larger banking system. So that's what's in this metric. And what have we discovered? We've discovered here in this next chart that the TBL liquidity index that we've designed has a strong correlation with the returns of Bitcoin and the stock market. And so TBL pros are able to keep up with our metric at all times and track how the conditions are set up for risk so that they are not getting bogged down in all the noise and the short-term price movements. When TBL liquidity is tanking, it's going south, it means either rates are spiking or the dollar is spiking or bond volatility is spiking. That is when we will flag it to you guys as TBL pros that, hey, something is not wrong, something is not right in the market, and something is wrong and something could be dangerous for Bitcoin here. In this next chart, TBL liquidity versus M2, I want to stick here for a second and explain what this chart is. So the M2 line here is the growth, the year-over-year change in money supply. So right now, money is growing at about 3.8% year over year. Our TBL liquidity index is above 50, which means over the last 12 months, it's expanding. Now, when we think about M2, M2 is a liability-based metric. It's the size of money in the system, US dollar onshore system. But remember that money is a liability. Remember your layered money framework here. Money, meaning deposits, is a liability. T-bills are a liability of the Treasury Department. Deposits are a liability of banks. Money market fund shares are a liability of money market fund issuers. And so money is a liability. It's not an asset. But the stock market is an asset. Bitcoin is an asset. And so when we think about liabilities driving asset prices, no, that's not the way that we think about it at the Bitcoin layer. We think about the banking side, the banking asset side of its balance sheet as the power to create money and risk-taking opportunities. Money is a result of the banking system's asset side. They can't create money without something on the asset side. So when we think about liquidity, we use asset-based liquidity, not liability-based liquidity. So when you hear M2, you know that it's not what we are talking about. We do not talk about M2. However, if you look at the chart, you can see that M2, the liability result of banking, is obviously correlated to the asset side of banking because assets and liabilities always match in a banking system. The reason we don't like liabilities is because we don't think that M2 captures the entire liquidity system. The liquidity of the system is captured by how many bonds banks own, the interest rates on those bonds, the volatility of those bonds, and all of that affects how much money they are willing to create in a fractional way. So that is why in purple, we have our TBL liquidity metric, which is asset-based. We confirmed to ourselves that it correlates with the liability side of things with M2, but we don't use M2. And that really sets us apart. And I believe it sets up TBL pros to understand how this system works better than those that are reading analysis revolving around M2. It is an incomplete liquidity metric, an incomplete monetary metric that does not capture bond volatility, for example, which we've proven to ourselves is a main driver of the Bitcoin price. So that is why we're working very hard here to deliver the signal and the research that we can through the Bitcoin layer. So thank you for your TBL Pro subscription, and thank you for subscribing here on the channel because it encourages us to keep pursuing excellence on global macroeconomic and Bitcoin research. I love this next chart designed by our fantastic researcher, Agustin Carrasco. Augustine put together a TBL liquidity chart versus consumer credit, but he lagged the consumer credit in red here back by a year. So what you can see is that TBL liquidity is actually leading the consumer. So over the next year, what we should see is the consumer continue to take on credit. And that is why we look at the asset side, because the asset side growing and being conducive to credit creation, that leads to higher stocks. Higher stocks leads to a wealth effect in which consumers feel more confident and go out and borrow and spend. So the trailing effects from liquidity, asset-based liquidity on consumer confidence are yet to be there. And that is something that keeps us bullish thinking about the overall risk markets. We'll switch over to US rates here and look at the 10-year yield. The 10-year at about 4.5% today. I believe that the Treasury market has finally come into some stability here. Now, when we think about the stock market reaching an all-time high yet again today on February 19th, we must consider that it's doing so with yields at 4.5%, close to the high end of their range. So if yields are high, why are stocks doing so well? Aren't high Treasury yields supposed to damage the attractiveness of the stock market, damage present value calculations of these equities? It's supposed to, but it isn't, because the economy is able to handle rates in the four handle. It just is. We have to use price as our best evidence. So bonds at 4.5%, but stocks at an all-time high, it means it's okay. It just means that it's okay. Bitcoin is close to its all-time high. It means the 4.5% isn't a disaster. And why isn't it a disaster specifically? If you look back at the end of 2023, yields were at 5%. So a year and a half later, yields are lower than where they were then. And so basically, conditions for credit, conditions for risk are good. They're good enough. And so we watch yields to tell us, hey, what is the compensation for inflation that investors are demanding? What is the riskiness of owning long-term treasuries versus short-term treasuries? We see a U.S. Treasury asset class that is finally coming into some support. Is it driven by just an overall moderation of inflation? Possibly yes. Is it driven by the new Trump administration lowering expenses, lowering the prospect for inflation with less government spending, and also introducing the idea that lots of energy, lots of oil production will cap oil prices and spur economic activity without damaging inflation readings that are really affected negatively when oil prices are skyrocketing? So low oil could be keeping yields low. Yields low could be supporting risk. That is how we put together charts across rates, Bitcoin, stocks, correlations, FX, commodities. We put it all together for you so that we are trying to extract the signal. All right, in our last chart, let's talk about that oil price versus yield. So instead of using Treasury nominal yields, I've taken out the inflation break-even component of Treasury yields. It's basically half of the interest rate calculation right now. We have real yields plus the inflation break-even component equals our nominal Treasury yield. So real yields are at about 2%. That's measured by tips. 10-year tips are trading at about 2%. And the inflation break-even at about 2.5%. That 2 plus 2.5 gets us to the 4.5% Treasury yield. When we look at the oil price below, 75 there in dark gray, the oil price and the inflation component of Treasury yields are strongly correlated. So higher oil production, higher supply, lower oil prices, lower yields. That's what Trump and Bessent want. Whether they will get it, we will have to see. Thanks for sticking with us today at the Bitcoin Layer. Definitely go subscribe and become a TBL Pro for this beautiful 76-page chart pack that we have here. thebitcoinlayer.com/subscribe. Make sure you're subscribed to the channel. And if you're a fan of the audio, you can find us on your favorite podcast platform. We'll catch you guys next time.